you got it on record that I have said that opportunity zones are the most powerful legislatively created tax incentive ever. But let's be real. These benefits, the opportunity zones, are going to have significant upside for you in the form of tax savings. But let's be real as well, is that there's significant downside for the IRS. And so it is going to make them give extra attention to them because they have so much to gain if they can unwind your deal. So I'm going to show you 5 of the most common potential audit traps that people are regularly stepping into that I see happening on a regular basis. I'm OZ Sherpa Ashley Tison. I founded OZPros, and I've helped investors, accountants, and advisors stay compliant and protect over $1 billion in deferred gains. I've had over 4,000 strategy calls since I started doing this back in 2018. Since May of that year, I have eaten, slept, and breathed opportunity zones, and literally nothing but. And over that course of time, I've seen some great deals, and I've seen some really bad ones. And so today, I'm going to walk you through the 5 audit traps that I see most often in opportunity zone investments and how you can sidestep them. Make sure that you listen the whole way through this so that you can get to the number 1, which is the most, and it's probably the most common, and it's the hardest to fix. Too many people jump into OZs chasing tax savings without setting up clean systems. Then they're not prepared for when the IRS comes knocking. And now there's a significant chance that they won't, but there's also a significant chance that they will. And if that happens, they scramble. It's actually really interesting is that most people would prefer to be mugged at gunpoint than get audited by the IRS, which I think is crazy, particularly if your audit trail is tight. And that scramble creates fear, it creates concern, sleepless nights, and it costs them money, time, and credibility. So let's get into the top 5 things that I have seen that people have jacked up in the context of their audit trail and make themselves open and able for the IRS to significantly challenge, if not completely collapse, your opportunity zone deal. And here's the problem, is that it could make it so that your ultimate big tax-free exit isn't tax-free. But it could also be that they go back in time and they assess substantial penalties and fees associated with the failure to pay taxes on time. So the first one is improper substantial improvement tracking. So the number one thing is that investors have not documented what their improvement threshold is. They don't know. They're like, well, I bought it for this amount. I'm like, okay, well, you get to spill that out into what the building's worth versus the land, but you need to have some kind of way to back that up. And most people don't have that, or a lot of people do not have that. The second thing is not documenting costs or confusing operating expenses with capitalized improvements, that they get those a little bit wonky too, because there's a difference. It needs to be capitalized. There's some operating expenses that can go into the substantial improvement, but the lion's share need to be capitalized improvements. Or you've bought personal property. You need to make sure that you have a means of being able to justify why that's going to count towards your substantial improvement. And that's what you need to make sure that you have clean evidence of that you've hit that threshold. One of the ways that you can do that is through a substantial improvement compliance certificate. That's included as part of your OZ Ascent 2.0 package. I'm going to tell you about that later on at the end of this video. The second one that I see a lot is that they've missed the 180-day clock. That is a hard and fast one, right? That is non-negotiable. If you are 181 days, sorry, Charlie, you're not going to be able to take advantage of having that investment count as a qualifying capital gain. Now, there are ways that we can fix that if we catch it early enough, which is one of the other things that we do. We review people's stuff to make sure they didn't jack it up and that they've got a good audit trail. That's one of the things that we regularly find. And a lot of times we're able to go back and to backfill that if we are able to get it early enough. If it's 10 years out, it ain't going to work because you haven't started your 10-year clock because you don't have a qualifying investment going into it. The other thing is about when you start your 180 days, is that it actually starts on the date of the sale. If you put 180 days into your AI generator and you say, what's 180 days from the date of sale? It's going to give you one extra day. You got to back it up a day. Those are the things and the tricks that you pick up over 7 years of doing this. The other thing is whether it's a personal gain or a K1 and when you get to choose your 180-day clock. A lot of people don't understand that. We regularly help people to understand that and make sure that they get it started inside of the correct window, because there is a dead period between the 380-day periods that you can choose. If you choose when the date of sale is, you got 180 days. You also can choose at the end of the year. You can also choose at the partnership tax filing deadline. But if your sale was on April the 15th, you've got 180 days. That would be October the 15th. From October 15th to the end of the year is a dead period. If you invested during that time and you treat it as a qualifying investment, it's not going to be. So we've got tricks to be able to work that. But once again, we need to make sure that we get a hold of that and we get a hold of it early. The other piece, and this is one of the big ones that we see, are inclusion events. People have made distributions or they've done refinancing where they've distributed in excess of their basis. That trip's an inclusion event. If it's significant enough, it could actually make it so that the whole investment is now non-qualifying. That's a problem. We need to get a hold of this early so that we can fix it. So we can either put it back in or we can reclassify it or make sure that it's documented correctly. Advisors and your CPAs must be monitoring this and making sure that your audit trail and that your book entries associated with how you're booking this stuff are done correctly. Weak reporting and poor documentation. Form 8996 and Form 8997 are not box checking exercises. The IRS expects accuracy in a paper trail. Missing documentation to back up your stuff in what you're doing is going to be a problem. If you don't have the stuff to back up the position that we're taking, that's going to be a situation. One of the big ones that's inside of that is for operating businesses. You got to have some way to be able to track your 50% gross income test. And we have lots of creative ways to do that we have come up with and we've helped people to figure out. But you got to make sure that it's done, and you have to make sure that you actually have it pulled and you've got it in an audit trail that you can use to back up the position that you've taken. But the biggest one that I've seen, and this is the death knell, is literally the death knell to an opportunity zone fund, is failure to timely file Form 8996. Form 8996 is a real easy form. They make it extra easy for somebody to self-certify that they are a qualified opportunity fund, but you actually have to file it. You have to check the box on the partnership tax return that you're filing Form 8996, and you have to attach it. And then inside of that Form 8996, it must be done correctly. If you do not, the only way to fix it is through a private letter ruling. The fee to the IRS for a private letter ruling is $12,500, plus another $15,000 for the preparer to prepare it for you. That's $30,000 in order to get your 8996 correctly filed and to get your qualified opportunity fund certification. Folks, audit readiness is not about perfection. It's about discipline. Track your costs, monitor your deadlines, confirm your tracks, where your opportunity zone transactions are. Watch for inclusion events. File clean reports and make sure to file them timely. It's discipline. It's putting in the reps. It's getting into the habit. You build these habits over time by having people to assist you and to make sure that you're doing it correctly. And you need to make sure that you've got access to a great coach who can then answer any questions that you've got and encourage you along the way and assist you in making sure that you are keeping your audit trail clean. Do that and you can focus on the real opportunity which is growing generational wealth tax-free. We'd love to help you along the way. We'd love to help you with a simple system that keeps you out of these traps. You can try Ascent 2.0 for free, 1 month on me. And this is our weekly membership built for investors, accountants, and advisors who want to stay audit ready, simplify compliance, and maximize every available OZ benefit. You get weekly live sessions with me, practical tools you can use immediately, and direct guidance on your deals and questions. I think it's the easiest and fastest way to an OZ PhD. It's conversational, easy to follow, and designed to give you confidence and OZ peace of mind. Looking forward to seeing you next Tuesday. This is OZ Sherpa. Ashley Tison out.